Good afternoon, everybody. My name's John Addis. I'm the founder and editor of Intelligent Investor, and I'm here to host a webinar with portfolio manager Nathan Bell on how to earn a higher, faster growing dividend stream. Now, before Nath kicks off with his voluminous amount of slides, which we've discussed at length, I just wanted to explain why we do these secondary offers. I think there's a few reasons for it. Firstly, it's kind of good discipline to have to do a webinar like this and explain our performance and our views. I suppose we could do it without the secondary offer, but that provides a kind of an incentive for us to do it. Secondly, there's no brokerage. So if you don't want to play brokerage, it's a great way to get into the fund. And thirdly, some people just like filling out forms. So if you want to do it the old way, that's fair enough. So this secondary offer has been open a week now. We feel as though the fund is very well positioned. I think Nate's going to explain the performance over the last few years, but we feel as though we've got a really interesting and good fund that's set for the period ahead. We've had a very, very good month. The offer closes next Friday, which is the 22nd of August. So you need to get your forms in and the checks or the deposits by then. I'll just quickly go over what Nathan's going to cover and then the format for it. So we're going to look at a few things. Firstly, how we identify high quality founder-led companies, why chasing yield alone can be a costly mistake, finding underappreciated income opportunities, which I think is a big one and a really interesting one, and why now may be the turning point for contrarian income strategies. Or at least we hope so, don't we, Nathan?
Oh man, do we hope so. What a difference 6 weeks makes, I tell you.
That's right. Okay, so because Nathan's got a ton of slides, we're not going to show all of them. He's going to skip through them. He's not being rude. This presentation is what you'll be sent when the webinar's over. So you'll get the full presentation, but Nate's just going to focus on the major points that he wants to make. Secondly, we've got a Q&A session. The presentation should run for about 45 minutes. We've got a Q&A session for 15 minutes, but Nath has given me permission to interrupt him at any time, which may be a fatal suggestion, Nath. So in the chat box there, if anybody wants to ask a question at a particular point, just type it into the comment section of the chat. And if I think it's a broad interest, I'll interrupt Nathan, ask him on the way through so he can get a break. He might disappear to go to the toilet and come back with a glass of water. I don't know while he's talking, but we'll see. Okay, so I'm going to hand over to Nathan now, and I hope you enjoy his presentation. Nathan, take it away.
Thanks, John, and welcome everyone. I do have a lot of slides, but some of them are very basic and I'll be flicking through them very quickly. So if there is a particular slide you want to spend some more time on, you'll have a copy of them to do that on your own. So I'm just going to go through these introductory slides and skip through to what we think income investing nirvana is after what, about 26 years now for Intelligent Investor of essentially running this fund. Before it was an actual fund, and then it became a listed ETF. It was our model income fund for our subscription business. So it has a very long history. It's certainly a relevant history. It's obviously not exactly the same when it's a model portfolio without real money, but the experience has been exactly the same. And this isn't a typical income fund. Most income funds are designed to maximize the yield, and this isn't one of those funds. This fund is designed to outperform, and therefore, because of that, we have to do things differently. So for those who are looking to maximize dividends today and maximize franking today, this is not the fund for you, but we actually believe you can have a high and growing yield and capital gains too, and outperform. So essentially, we believe you can have your cake and eat it too. And our experience and our aim for this fund is to outperform by 1 to 2% after fees per annum. But most important is that we find companies that can grow their dividends. And that's the real difference between, say, buying a bank, which can hardly grow their earnings, or actually they're not even growing their earnings, some of them at the moment, versus some of the stocks or all of the stocks we're going to talk about. And if you can't outperform, then in my view, it's actually, you're just better off buying an index fund, because that takes the risk out of underperforming, and normally you get a pretty decent yield. I think historically it's probably run at 5.5%, something like that, plus franking credits on top. So if you're not going to outperform the index, then it's actually a pretty low risk and low stress way just to buy an index fund. Because all you end up doing then is paying fees for someone who's going to guarantee that you're going to underperform. maybe there's some slightly added yield or some slightly added franking benefits, but why would you want that if you're still going to underperform and pay fees? It doesn't really make a lot of sense. It sounds simple, but it's actually quite hard to do, which is why I've said most income funds you'll see are designed to maximize the yield. And they're actually easy to spot because they use inferior benchmarks because they know they can't outperform the market. So they'll have something like the RBA cash rate or maybe just some arbitrary number like 8% or something that's well below the long-term return of the index.
No need to name names at this point, Nate. Keep it quiet, please.
It's actually easier to spot the very few income funds out there that are designed to outperform than it is to follow the rest, because it's actually not normal for an income fund to be putting themselves out there to outperform. So in that sense, as if being an active value manager in these days is not irregular enough to have a value fund that's actually an income fund designed to outperform really puts you in a unique category. And if we actually can outperform by 1 to 2% per annum after fees, that essentially would make you the best performing income fund in the market. So it's amazing how slim the margins are when you're running this type of fund. 1 to 2% might not sound much to people, but I always put this slide in there, which is as much for me as it is for anybody else. And it just shows the difference of a 1 or 2% increase in your returns over time. And you can see sort of over 6 or 7, even 10 years, it doesn't really make that much difference to you. But once you get through that period and beyond, it makes an enormous difference. And that's really what we're trying to do. We're trying to find the great companies that can actually grow their dividends for decades and pay an appropriate price. And that's really where the strategy gets complicated from our point of view, or not complicated, but difficult, because it's certainly not easy. And I won't rush ahead. We'll just slip through a couple of slides there. So this is for people who have watched this webinar over the years, you know the answer to this already. I haven't changed the stocks, but I always like doing this slide, particularly for new people, but because it's a great illustration of what we're trying to do, and there's some quirks about these two particular stocks that make it particularly interesting right at this minute. So this is which income stock would you choose? There's company A, which is a stock that I recommended way back I didn't have grey hair at Intelligent Investor. I think it was 2010, so just after the GFC. And it was a stock that was trading at around $30. The dividend yield was only 2.2%. But since then, the capital gains have been 15% per annum. And surprisingly, the stock price has gone nowhere for 6 years and probably looks cheap at the moment. But most importantly, the dividend growth over that period is 12% per annum. And so the dividend today, based on that original buy price, is 14%. All right, so that's exactly what we're obviously looking for. We want the capital growth and we want the dividend growth as well. And it goes without saying that any company that can grow their dividends that fast over such a long period of time is going to be a very highly valued business where you're obviously going to get good capital gains. Now, Company B is the stock that I would expect most people would have chose back in 2010. And at the time, that stock was trading at $56 and it was yielding 5.2% fully franked. So that's like 150% higher yield. So I imagine most dividend people would have picked that. The capital gains have actually been okay, so 7.7% per annum. But the dividend growth has been much, much lower, and that's more representative of the earnings growth. And the dividend growth has only been 3.2%. So basically 1/5 or a quarter of what company A has done. And that's the big difference. And so today, even though you've held this stock for theoretically at least for 15 years, your yield today on that original recommendation price from way back in January 2010 is only 8%. So almost half what company A is. And so the answer as to which company is which, company A is CSL and company B is CBA. And what's even more surprising, I think, to most people about that is that Commonwealth Bank, in my view, is probably trading at almost double what it's worth. And so imagine what this comparison would look like if those capital gains for Commonwealth Bank were more like what I think they're going to end up being fairly shortly, would be more like 4% per annum. And that's been generous compared to CSL.
Nathan, are you saying there that the yield, so the most obvious figure that income investors look at is the yield right now, and you're saying that is not the most important thing?
That's exactly what I'm saying. And what we want, and I can't say this enough, there's a lot we're going to go through, but if you just take one message away from this webinar, it's that you have to find growing yields. And if you're going to find growing yields, you've got to find companies that can grow their earnings. So all the stuff, sort of, I guess, all the Buffett type of stuff we look for, the insider management with big stakes in the business, the competitive advantages, all that stuff, that we're still looking for all that stuff. But what we want to do is find these companies early in their life cycle, so we go through decades of dividend growth. And you could easily pick other companies, right? Like company A could be REA Group, or we could be unfair and go company B is Westpac, and then imagine how pitiful those numbers would look like. So I don't think we're cherry picking. I think it's sort of a nice example where one stock's drastically overvalued, one's not, and yet the comparison is still stark. So I just thought I'd throw this in there. This is a stock that Intelligent Investor members and investors will know well. We don't own it at the moment, but I just thought it's a good example. I think it's the first or certainly the second best performing stock we've had in the fund. It's a fund manager, and in some ways it actually typifies what most people are scared of with income investing, is that they don't want to buy highly cyclical companies. They don't want things that feel risky to them, unknown. Income investors want to buy the big, strong, familiar names. But if you're going to buy those stocks and maximize your yield, you just don't get the growth, and then you can't outperform. So you can see how it's all tied together. And Pinnacle Investment Management is a fund manager. It's a bit like the old Treasury Group that some investors may remember. It has a stable of over 20 funds now. It's grown from, I think it's nearly $200 billion now. It's been incredible. But what I want you to really pay attention to is not any of the details about the company, but it's just the dividend. And you can see that it's grown, since we bought it, I think it's grown dividends 45% a year. That's the difference. These are the stocks that we're really looking forward to. These are the ones we want to find, because if your dividend is growing at 40 or 45% a year, you're getting all that capital growth and the incredible increases in your dividend as well. I wish we had a portfolio of 20 of these sort of companies, but the world doesn't work like that, and these are pretty rare. But this is exactly what I think is the archetype of what we're looking for. And you can see the dividends actually went down in 2002. So it's not like we're trying to pick companies that the dividend just goes up every year, but we're trying to look through the cycle. We're looking long term. Is this a business that can grow? Is it well run? Is it highly profitable? Is it going to have the cash to continue in increasing dividends? It's just a very different, I think, archetype or example compared to if you're sitting there looking at the banks at the moment and going, okay, they're pretty expensive anyway, but 3 of the big 4 banks are expected to cut their dividends in the years ahead. Like, they are absolutely paying out their max dividends. CBA is the only one that might be able to get away with that. But this is a very different story. This is a business that doesn't need a whole lot of cash to reinvest in systems like the banks do. It doesn't have the staff. It's like the gross margins in this business are absolutely incredible. And because you've got that huge free cash flow and you don't need to keep reinvesting to grow the business, it basically grows this business with almost nil reinvestment. Like, it's quite remarkable. On the flip side, that has risks of its own as well. Obviously, it's a very people-orientated business, but it's becoming more diversified all the time and therefore less risky. But the key is just the ability to keep on paying those higher dividends. And because you've got a founder running the business who takes most of his remuneration or gets most of his return from the dividends from the business, it's paying out the dividends like we'd expect if we owned the business. And so that's sort of, I guess, like the holy trilogy. Maybe it's more than 3 things, but you're trying to put together. You're trying to put the founder still running the business. You want growth for decades ahead, a sensible and safe strategy, lots of cash flow, competitive advantages, all those types of things thrown into the mix. But one thing this isn't is we're not trying to maximize the dividend yield today. We're trying to make sure we're maximizing the dividend growth for the decades ahead. So that's sort of the introduction to the fund. So for anyone new who maybe has questions about the fund itself or how we go about it, by all means ask in the Q&A section. But for the next 15 minutes, I'm just going to fly through some slides that talk about where the returns from the index have come and why we've outperformed accordingly over the last 30 months. Then I'm going to talk about what's changed, and then I'm talk about the good news is I think we're at the beginning of a great change. It's going to be great for the fund and get our returns back to where they were 3 years ago. And so then you'll have expectations about what to expect from us as the market goes away from just paying any price for banks and all these other stocks and actually looking at the value of stocks and finding out where the returns from the future are going to come from, not where they've been. So I'll just very quickly on this slide, because we're going to dive right into the detail. Obviously, the greatest thing here for people who've been invested in the fund is that last month. In fact, in the last 6 weeks, we've outperformed by, I think, about 8%. In the actual returns, we've basically got more than a year's return in less than 6 weeks. And I know that the last 30 months has been really hard, coming down from when we were absolutely flying. In 2022, we were one of the only funds out there that outperformed with our coal stocks before they went down again. But it's been a remarkable 6 weeks, and it just reinforces what I've been saying over the last couple of years, is that you have to go through these periods of underperformance. But what you can't do is afford to miss the turn, because by the time the turn becomes a trend, so by the time the market goes away from just paying anything for growth stocks or banks or whatever it is and switches towards value, you'll have missed 20% of the returns or more. And if you miss those returns, then you're going to have average to poor returns and you're not going to be able to outperform. So finally, it's been a long wait. It was an absolutely fantastic ride between 2019 and 2022 after I came back to the business. Obviously, those sort of returns, I think we outperformed by about 8% a year there for 4 years, which is obviously unsustainable. But normally when we go through these sort of really hard, tough, I say tough from a value investor's perspective, bull market, normally it's the growth stocks, the stocks with AI, like we always expect to underperform due to those stocks, like a Pro Medicus perhaps. But I never thought it would be the banks that would cause the most damage to our relative returns to the index. And as you've seen from CBA over the last few days, there's a long way to go for that share price to get back to fair value. It's about 11% of the index at the moment. But as they go back down and our fund continues to perform, you can see the orange line's going to should go back to where it was in 22. So that's what we're aiming for. So let's just quickly dive in. So
I just want to tell attendees, Nate, how you in our weekly Monday morning meeting, Nate often says, when the banks give us back our 2%, in particular reference to the income fund. So you can see that this is something that's very close to his heart.
So we're going to jump into the banks specifically, but I still think they owe us about 8 to 10% from where they are today. Actually, I won't jump ahead, but they do owe us big time. Funnily enough, I talked to the team recently, and there was when we were flush with cash at the end of 21, when we had a couple of big takeovers, and we were selling some stocks that have reached fair value. We had a lot of cash, and I thought, geez, is this the time? So I just buy a big stake in the banks, because we'll probably get I guess probably a 7 to 7.5% return, maybe 8% return if you're lucky. And I said there, looked at the portfolio and go, well, we can do better than that. And if that's all we're going to do, then people shouldn't be paying us money. Little in my wildest imagination or nightmares did I actually think that the banks were going to go up 80% over the next 2 years, when the fundamentals have actually been far worse than I ever imagined. Like I actually thought there would be some growth, and there actually hasn't been. So it just shows you how crazy the market gets at times. I just love this slide. I just picked this off another fund manager recently, and it just shows the period between 98 and 2000, when the tech boom was in full-fledged. And this really sums up, I think, our recent performance across our Australian funds is, we are the Berkshire Hathaway, we are the grey line, where we've just gone down for no real reason, nothing to do with our stock picking or the stocks we own. And yet the market's just gone, essentially bananas, up about 30% there, or more than that. It's like 40% from August 98. And that was all built on nothing. And Berkshire was the great company that had all the fundamentals, great management and all the rest of it. Now, I'm not going to show you the end of this slide. I just want you to remember this slide. So when we go through this next group of slides and we pop out the other end, I want to come back and show you the ending. So this is a slide which I think is quite amazing. I don't think people realize that the US has the Magnificent Seven, which has become, I think there's another acronym now, but it's sort of shrunk to the Magnificent Five. And people don't realize that in Australia, virtually all or most of the returns have actually come from 5 stocks over the last 2 years. And I've called them the not so magnificent 5. They're responsible for 53% of the outperformance of the index over the last 2 years. And 2 of those stocks, their earnings have gone backwards. One of them is CBA. I think it's grown its earnings at 1%. Goodman actually has some right to consider itself a bit magnificent, and I wish we had bought that in 2020, but we thought we had better ideas at the time. And Wesfarmers is a great business, but it doesn't deserve to be trading at 40 times earnings. So that's where all the returns have come from, and that's essentially why we've underperformed, not because we've been making big mistakes or picking the wrong stocks. Now, as you would imagine, if you're familiar with CBA, which everyone talks about every day, trading at 30 times earnings, and is the most glaringly obvious bubble of all the stocks out there, you can see that over the last couple of years, the market's gone up 30%, and now it's drastically, I'd say drastically overvalued compared to where it has been typically. And I say drastically because most of that is in two sectors, and that's the banks and the industrials. And what's actually interesting is if that 30% gain has come over a period of time where earnings for the index have fallen 3 years in a row. And I don't actually expect much to happen next year. If we're flat next year, I think that would be a pretty good outcome. But a lot of people are penciling in big growth because interest rates are going down. But personally, I don't think that's going to be the case. So you've got this index that's put on 30% very quickly while earnings have been falling, which is clearly unsustainable. And you can see that's just come from all those stocks, those 5 stocks I showed you, which are the industrials. And if I had this chart right up to the minute, I think that would be probably another 10 to 20% even higher again. So we're a long way from the average for those particular stocks, and that's not where the value is, obviously. I just threw this slide in there. You don't need to read it, but a lot of the sort of animal spirits, I guess, in the market at the moment are coming from people believing in an AI story. And I just love this bit of information that people don't realize that the internet was probably the greatest change, at least in modern history, for companies and for the world as far as technology goes. And yet, despite that, recognizing that, the point of this slide is not to show how terrible the returns were in the aftermath of the tech boom, which is probably a good point to point out. But it was actually that productivity didn't actually increase since, and corporate profits didn't increase since. And that's what a lot of, I think, the fluff in values for tech stocks at the moment is based on. I don't actually think the bubbly nature of the tech sector is in the most well-recognized names like the Magnificent Seven. I think they're just incredible companies, but it's everything underneath that that we don't generally talk about in Australia because they're sort of less familiar names in the US. But I just sort of throw this chart in there because to me, the two big sectors that are getting all the money is tech and banks. And I think basically my point is that the valuations across the board are not built on genuine value creation or earnings. And obviously that's unsustainable. That slide there just basically reiterates that. There's another comment there about how capital intensive now. I actually saw a slide this morning with some data, which would have been nice to include. I don't know if, John, you saw it, but there's something crazy like the amount of capital expenditure coming from the 7 AI big tech stocks in the US is something like half or 70% or something of the entire capex of the entire country.
Yeah. And most of the increase in GDP.
Just unbelievable. I actually, you think you've seen it all, and like every statistic you see at the moment, you think you're going to fall off your chair, but that one was just amazing. And I think if you include that with government spending, which I'm not going to talk about today, you can see why the economy is getting by, even though it's becoming more indebted. These are 2 pillars of the US economy that's kept it powering along, no matter about Liberation Day and all these things that you think might have upended it.
Just one comment there. I mean, when we go back to the dot-com sector, the dot-com era, everybody thinks about Cisco, which provided sort of, what would you call it, the shovels to the internet, like the pipes and wires. In the really, really worst case for AI, we might have 5 or 6 Ciscos rather than one. It's a possible scenario, I think. Not likely, but in the worst case, it could be that.
So a follow on that, we won't go into detail today, but it was basically came from a post that said no one's actually making any money directly from AI at the moment. And that was no different to 99. Like everybody knew the internet was going to revolutionize things, but you didn't actually know who the big winners were going to be at the moment, but you could see who was spending all the money. And there are nuances today, but it's a nice segue to the title of this slide is like, when did the banks become AI stocks? I saw I actually saw some updated percentages yesterday about who actually owns the Australian banks. And it's not actually Australians anymore. Australians have actually been intelligently, in my view, selling them down. That not just fund managers, but individuals as well. And actually, most of the ownership now of the banks is from overseas fund managers who are trying to escape markets they don't want to be in. So the US market is getting away from Trump, or Australia is seen as a very safe haven compared to Asian markets, for example. So we're a constant place, a safe place to park money. And people have just thought, well, I don't want to own the other three banks. CBA is stable, and as long as it doesn't disappoint on earnings, I should be right. But they've been wrong in the last few weeks. And funny enough, I think with Westpac's result this morning, the headline in the Fin Review was all these fund managers, overseas fund managers, are now swapping from CBA to Westpac. So I feel like they're a glutton for punishment myself. But anyway, but the point of this slide, though, is that the banks are about a third of the index now. And when they go back to fair value, that's going to be a huge tailwind for our fund because we haven't owned any of them for years. In that period in 2019 and 22, we didn't own any banks. I think one of the first things I did when I rejoined the company was sell the last of the banks in the fund. And that's what allowed us to outperform by nearly 40% in those 4 years. And obviously, it's been a pain for the last 2 or 3 years because you go, oh, geez, why weren't you in the banks? But it's not our job to speculate on what stocks are going to become bubble stocks. That's just really silly stuff. And if you lose your mooring and you're not focused on valuation, then you're not going to have great long returns. You're just going to be sitting around trying to speculate on bubbles. That's a crazy way to invest in my view. I just thought I'd quickly explain why. I think this is underappreciated. I think everybody knows that passive investing has had some impact on the market and on the banks. But as I just said, with the banks, it's actually mostly overseas investors more than anything. But this was just something I didn't quite appreciate. When we went into COVID, ScoMo did a couple of things. The worst thing he did was double the fees on my kids' university fees for the next 5 years. And I'll be forever angry about that. But one of the other things he did when he had about 5 different hats on was he actually had the right thinking. But as always with the government, sometimes they do have the right thoughts or they identify the right issue, but the way they try to deal with it is crazy. And he actually introduced these your super, your future rules. And what it basically says is, if you underperform for 2 years in a row by a material amount, which actually isn't that material, then you cannot take on any new clients. So you can imagine the industry super funds. What do you think they're going? How do you think they're going to respond when, if they're any way, their performance is any way removed from the index, and they can't take any more customers? So of course they're going to start indexing their returns. They're already pretty much indexed anyway because they've got no choice given their size. But I just love this little quote I got from an article which points out the obvious, that there is evidence that the test may be influencing investment decisions to the detriment of member outcomes, including discouraging investment in asset classes that may otherwise be in the best financial interest of members. So I think an obvious one to me is private assets, private credit, private equity, all these sort of things. So I think this is something that's gone underappreciated, is what's driving up the bank share prices. And I've got this slide here, and this is my view of what you should expect if you own the banks. If you own Commonwealth Bank, you'll be lucky to do 4%, in my view. That's without franking credits, over 4% a year over the next decade. If you own a portfolio of the 4 banks, then I reckon you'll be lucky to do 5. And that's if absolutely everything goes right. No bad debts, no cycle. Macquarie doesn't steal any more market share. No new companies come in and work out better ways to sell mortgages. Brokers don't take even more share of mortgages. That's the best you can expect. So I think the hurdle right now for active managers is basically as low as you could ever hope for it to get, which has been punishing for us for the last 30 months, but it sets us up beautifully for the decade ahead. So just quickly again, this just reinforces where growth stocks are at. I think if I had, again, this right up to the minute, we'd probably be much closer to that blue peak from 2020. And you can just see how rare it actually is for growth stocks to be trading at these premiums. We really are in a rare time. We're comparing ourselves to 2020 when things were absolutely crazy during COVID. It's actually amazing going to look back some of the share prices of some of the stocks and seeing where they were. I don't think people appreciate just how mental it was when everybody was sitting home with nothing to do, but everyone had money either from the government or their job, and they had nothing to do and was speculating on stocks. It really was remarkable. But we're compared to that period and the tech boom. Otherwise we're nowhere near ordinary for those particular stocks. So you can see where all the overvaluation is. And I think even though I've mentioned a few names and the banks in particular, it's just really interesting to look at a broader group of stocks and seeing how price to earnings ratios have increased in a very short period of time. This compares 2019, which wasn't a period where the market was especially cheap, to May 2025, and it just shows you it's much broader. It's not just the banks, it's not just tech stocks, it's absolutely across the market. There's, Woolworths, with very minimal growth. We own it in the fund, but has very minimal growth. It's trading at 28 times versus 21. The fundamentals for most of these companies has got far worse, in that period. Like, they're not better businesses than they were. Maybe REA Group is, but certainly APA is not. Woolworths is not. Coles is better managed, but not a better business. Telstra, again, better managed, but not a better business. NAB's not growing faster now than it was back then, or anything like that. Stockland is exactly the same business and probably faces dimmer prospects than ever. And a lot of these companies just suffer because of their own success. They're just giant businesses and they're only Australian businesses and they've got nowhere to grow. So you should be paying less for those businesses, not 50% to 100% more. Again, I'm just pointing this out because a lot of these stocks, most people wouldn't pay much attention to, but they're part of the reason why we've underperformed over the last 30 months. And I just sort of throw this last one in because it's just one of my favorites. It more than anything, it just shows you where animal spirits are. And you should always remember that what happens in the US is what happens in Australia. And that's why I spend a lot of time focusing on what's going on over there, because as I've shown in a previous webinar, the reason price to earnings ratios increase in Australia is simply because they increase in America. It's just animal spirits. It's got nothing to do with the differences in Australia. But I'll just read some of this because I just really like this quote. It just gives you a bit of a clue for what's going on outside sort of some of the more popular stocks we tend to look at. So I think this was the March quarter, and it said, this is from a guy called Dan Lissick in the States, the total market cap of stocks with price to sales, this is price to sales, not earnings, greater than 20 times, reached an all-time high of $6 trillion. That's 1 trillion higher than 2022's peak, and is nearly 2 times the .com peak. And I just really like this little quote here from Dan Lissick of Kalish Capital. One has had 2 times better odds at a casino than having success investing in stocks with valuation multiples over 20 times sales over the long term. All right, so that's the animal spirits that are driving in the market. And we're obviously not playing that game, and it's not important to us. But I just want to explain more that animal spirits are driving a lot of the nonsense you're seeing in markets, and that will turn. But when you've got a portfolio like ours, it's actually undervalued and based on fundamentals, and the market hasn't been interested. There's absolutely, I wish we had a portfolio that was a bubble portfolio at the moment. Our returns would be 40 or 50% higher, and we'd just be selling stocks and waiting for the crash. But the point is that there's just been all these stocks, which we call value stocks, that are absolutely wonderful, sensible businesses that actually used to be the darlings of the market. But for one reason or another, the market's just leaving them behind, has no interest in them.
And that's the opportunity, right, Nath, right now?
It absolutely is. And we're about to jump into those. But I just want to show you this chart because I think people have forgotten this. Jim Grant, who I still love, I think he's the greatest financial author of all time, because he's funny and witty. And aside from our own John Addis, of course. But he also has a long history with US markets, and I think he actually makes history fun in a way John also does, but just not as doesn't write as much. There's lots of old books you can read if anyone's interested. But this chart here is the All Ordinaries Index from 2007 to 2023. So this is basically what I think we're looking at for the next decade as well. I think that period in 2007 before the GFC, not that I'm expecting a GFC, but just in terms of valuations of the small group of stocks that are enjoying those valuations at the moment, which did include the banks back then as well. That was the last time they traded anywhere near these extraordinary valuations. You basically had 17 years of no capital growth, 17 years. And you got a yield of about 5.5%. So if you were happy with that, that was fine. But if you really consider and think you can stomach 17 years of no capital growth, you're a far better person than I am. And the thing is, you just don't need to. The other message, as we're about to go into when we start talking about the stocks, is the most sensible thing to do right now to try and earn 8 to 10% a year in the decade ahead is obvious to anyone. The difference is there will be very few people that are actually willing to make the change in their portfolios to earn it. This is not rocket science. All we want to do is avoid a lost decade like this with sensible stocks, and that's what I'm about to jump into.
Nath, we're at 35 minutes now.
Yeah,
We're
this will be
halfway through the slide, so
this part will be very quick. So here's the difference between the most expensive stocks in the market and the cheapest, and you can see it's almost at a record. And in fact, so I'll just jump ahead to this slide. For the resources sector, where we've got a bit of exposure, which I'll go through in a minute, actually this hasn't happened in 65 years. So it just shows you how out of favor the out of favor stocks are. This is probably the one slide I want people to remember from the presentation. And this is the period after the tech bust from 2000 and 2006, where a lot of US hedge funders that we are familiar with today made their reputation. And you can see in the bottom row, large growth stocks in the US fell by about 5% a year for the next 6 years. So in accumulation, they fell about 30%. But a large value fund, on average, they went up about 8%. So they outperformed by about 13% for 6 years. And I think this current period rhymes with that period, and that's what we're trying to do. And so how are we going to do that? So just this one slide just reconfirms where we are at the moment. This is Jeremy Grantham, who people probably most associate with the big bubble caller. And this reinforces those charts I just showed, because it's nice to have this information from as many different points of view as possible. And if we go back to that slide there, it shows we're not quite back at where we were in 2000. We're not quite as cheap, but we're not far away. And that's, if you believe in those forecasts, that's essentially saying the same thing. So these are the 4 stocks we own in the resources sleeve of our portfolio. And quite remarkably, 2 of them boast huge dividend yields. So New Hope, I think, is fully franked 9%, which normally would be a red flag for me. And I haven't talked about it before, but normally with income stocks, you've got to worry about the rule of 10%. If you see a stock trading on a 10% dividend yield, there's 99.9% guaranteed that dividend's about to be cut. Because
they do it well to keep it below that double-digit figure. I'm sure they could go higher if they wanted.
Because the thing is, the market's not dumb. Like, the market does things like push CBA to 30 times earnings for certain reasons that last a year or two, but the market eventually gets things right. And Karoon Energy is another one with a big dividend yield as well. It's a bit smaller than it has been because it's gone up a lot recently. I want to talk about the 2 stocks. I think Mineral Resources finally on its way back. I think it's up 150% or something from the lows in the last 2 months. It's just crazy how low that got. But the point is that normally when you think of resources stocks, you think of the BHPs of the world, which are very low growth, and they face big problems with their dividends. They've already been cutting them, the iron ore miners, with the massive Simandou project coming online. So we don't expect higher iron ore prices. That's why we're not invested in them. But normally when you think of resources companies, you think about how capital intensive they are, how much money they need to keep reinvesting to sustain profits. And yet New Hope is trading on a 9% fully franked dividend yield with coal prices depressed. And yet, as you can see from this chart on the left, it's going to double production over the next couple of years. So imagine if production has doubled and all of a sudden coal prices get on a bit of a tear. Like there's just huge potential like that in the portfolio that's not currently being recognised.
That might be a good place to mention Bob's question about Woodside. It's paying nearly 10% yield. Why isn't that in the income portfolio?
Yes, so we owned it at much lower share prices at one point, but the problem is that the 10% yield is a furphy. You don't really get the 10% yield because you have to keep putting in more capital into the business because it's got these giant investments it needs to make. So that's a perfect example of, to me, of what is the opposite of a Pinnacle. With Pinnacle investment, that dividends were real and they didn't have to raise capital. And there's, you don't have to keep putting in a massive dividend reinvestment plan like the banks do to keep paying those dividends. So yes, the 10% sounds great, but there's a reason why Woodside share price hasn't gone anywhere for so long. And
it's paying out with one hand and taking it back with the other.
Exactly. And I actually like our coal stocks are much cheaper. And when they pay out the dividends, their real dividends, and the coal price is depressed at the moment. So I don't know when they're going to go up, but we much prefer those. I should point out the gas and coal prices are interlinked. They influence each other. It's too much to go into today, but so essentially we much prefer the coal stocks than we do Woodside and Karoon, for that matter. It does oil and gas. And this is another area where there's, I think, a lot of value. I don't think it's this extreme in Australia. These are US numbers, but the small cap, generationally cheap compared to large cap stocks. And normally when you say small caps, I think people think really risky micro caps. And our 5 stocks there that are considered small caps couldn't be any further from the truth. They've all got incredible balance sheets. They're all founder-led. Most of them either pay massive dividends or are buying back stock hand over fist. MA Financial is hopefully going to double its earnings and dividends over the next 3 years, and I expect that to be the next pinnacle. Aussie Broadband's just paid its maiden dividend. RPM Global has been a huge winner for the fund and is buying back a heap of shares. Lavisa is just a cash flow machine. We bought some more shares. We sold some in the mid-30s not long ago, and we bought them back in April, and quite unbelievably, they're up 75% in a matter of a few months. So we've been selling down again. I think the next decade looks extremely bright for these stocks, but I actually don't think a couple of these will end up being listed. I think Aussie Broadband and RBM Global will be taken over at some point. This is a sort of complicated slide. I won't go into too much detail, but what it says is normally it feels like you have to take extra risk to get extra returns, but we've got this strange situation at the moment where, because the market is just bidding up this very small group of stocks, it's left these absolutely wonderful companies sitting there doing nothing, even though there's nothing really wrong with them. So what this slide is telling you is you can actually take less risk and get a better return from owning better quality companies. And these are 3 healthcare companies that I think fit the bill. Like these used to be market darlings, and yet ResMed is growing beautifully and only trades at low 20s multiple, when CBA is trading at 30 times and can barely grow its earnings, and ResMed's growing up at double digits. This wonderful company, and yet trades at low 20s. Like, it doesn't make any sense. CSL's targeting double-digit earnings growth, and yes, the share price hasn't gone anywhere for 6 years, but that's part of the reason why now it's cheap. And Sonic Haircare is another ex-market darling, which isn't growing as fast as those two. But these are the stocks when I first came into Intelligent Investor in 2006 that everybody wanted to own, and everyone was paying massive multiples for them. And now no one's interested in them, yet they're still doing what they've been doing for decades. And there's a chart of their price to earnings ratios. You can see how far they've come down in a short period. The Sonic Healthcare one looks a bit funny because it had COVID profits in there. But we actually think it's invested its one-off COVID profits pretty well, and we'll get the benefit of that in increasing return on equity over time. So we're wrapping up now the formal presentation, but remember that slide I talked about with Berkshire Hathaway, which underperformed drastically in 98, 99 in the lead up to the tech boom and bust. This is what Berkshire Hathaway did in the decades afterwards, and this is exactly what I would expect the market and our fund to do over time. This is just the last slide here on the distributions and the yield. I'm sure someone will ask. So the running yield of the fund at the moment is 3.5%, and that's in line with the index. That's before franking credits. But there's 2 things you need to know. And the first thing is we obviously expect our dividends to increase over time. And again, as I talked about at the intro of the presentation, that's the key to successful investing, because any company that can increase its dividends for decades is going to get big capital gains as well. And that's how you have your cake and eat it too, and that's how you outperform. I talked about Aussie Broadband, for example. It's just paid its first dividend, so clearly there's going to be a huge amount of growth in its dividend. MA Financial, I think it can double its dividend over the next 3 years. And yet, if you look at the index, yes, it's yielding 3.5%, but 3 of the 4 big banks are expected to cut their dividends, and the iron ore miners will probably cut their dividends again as well when the big Simandou project comes online. So that's the key thing to take out of that. But if we were to pay our distribution right now, we've actually got a lot of capital gains to pay out, like we did with our most recent distribution. So the actual distribution coming out as things stand will actually be much higher than that, because we've been chipping away, selling a number of stocks that become big positions or have reached fair value. So we've really gone through 2 years where we were just paying out the underlying running yield of the fund from the dividends coming from the companies, because we had no big capital gains. but that's changed now. So expect those high distributions from here. And just the very last point I always make with our funds is, because we always get a question on this, is people look at our listed ETFs and they see no volume or low volume, and they think that's actually a reflection of low liquidity in the funds. But it's actually not like that, because these are listed ETFs. The daily volume is just the demand and supply for the units in the fund. In terms of the actual liquidity of the fund, the average market cap size of the stocks in the fund is many, many billions of dollars. So and it's the one thing that I get from our investment committee is all about the liquidity of the fund, and we have very, very strict liquidity constraints on the fund due to the ASX and due to our funds being listed that we have to oblige. So that's why we don't own even more small cap funds. So just don't make the mistake that seeing the low volumes of the trading in the fund is actually reflective of the liquidity of the fund.
Thank you, Nath. I'm sure we're going to get lots of questions. I'm going to kick off with one question. You never miss an opportunity to give CBA a good kicking. Fair enough. But I imagine there's lots of people in this webinar who do still hold the banks and have maybe held them for a long time. They've probably got quite big CGT liabilities there. How do you weigh up the cost of selling down CBA in order to, which pays out, pretty good dividends, even though there's no growth, in order to move into the kind of stocks that you've been talking about today? How would you, as a portfolio manager, how would you balance and evaluate that kind of decision?
Yeah, so I think it's a really individual decision, and that's what makes it difficult, because we just sit here every day and look at what's going to give us the best returns, and we'll just get in and out as we need to. But if you're someone who's owned CBA since the 90s and got these huge capital gains, and if you're happy with earning a 4% return at best and getting your franking credits, and if you want to stay with that, but you also understand the risk that actually at some point you might have a big loss from here, that stock could easily fall 40%. And if we actually had a recession one day, could even fall much further. As long as you're happy with that risk, then you may not want to change. But you just got to be realistic. That's the main thing. As long as you're making the decision that's right for you, that's all you need to do. But what I would do is point you to Livewire actually had an article recently on their website, and I think it was a fund manager who explained that he actually, for the first time, got his mother to sell her CBA shares, because for the first time it actually made sense to pay the capital gains and then I think even just put her money in the bank. That's quite remarkable, because the thing is, it's the tax that you have to pay, right? And then people say, okay, well, after I pay the tax, it's just not worth buying these other stocks, even if the return's pretty good. But CBA's valuation got so high recently that didn't hold true anymore. So if you are actually thinking maybe that you could actually possibly sell it and try to get a higher earning something, then go and read that article that actually goes through the tax and the mechanics.
Okay. One more question in terms of the resources stocks, because I think many income investors look at resource stocks and go, well, they're cyclical. I don't want that. I need a reliable dividend. What kind of mental adjustments do you have to make in order to see them as income stock, potentially good income stocks?
Yeah, so there's a couple of things there. First, I'd say is, the mineral resources and our coal stocks, which both of we neglected to sell when we should have, with big capital gains on them, have been the bane of my existence over the last 30 months. So I won't be rushing back into any resources stocks anytime soon. But we just had this but we're actually at this and the thing that I think annoys me the most is I never buy resources stocks anyway. I think anyone who's followed my career at Intelligent Investor knows that, but I just thought these were unique opportunities. But I think old lessons were learned. But nonetheless, remember that slide I showed you about just how cheap commodities are at the moment generally, compared to all other stocks. Like, this is something that hasn't happened since I think 1965. And what that's telling you is people are just so enamored with AI and the Buffett way of investing, of just competitive advantages and low capital requirements and huge margins, all that sort of stuff, that these stocks have just been absolutely left for dead. And so obviously we restrict the amount of resources stocks we're going to own in the first place, so that keeps the risk fairly low. But Karoon Energy is one where we've actually had an agitator, Fred Woolard, who's a friend of Intelligent Investor, who got in there and got the board to change their remuneration. So it's not, what's unusual about these particular stocks is just how well managed they are, with founders that are running them. New Hope Coal is out of the Soul Patts family, the Milner family, which are well known in Australia. These are very sensibly run businesses with very sensible expansion plans, but they're already growing their earnings and paying big dividends already. So you are getting your cake and eating it too, and that doesn't happen very often. Normally it's like Woodside, where, okay, you might get a big dividend, but you never really get any capital gains, because you get some capital gains when the underlying commodity price goes up, but then it just goes back down, and then there's a capital raising for the next project, and you end up just, it's like concrete shoes. You just don't really get anywhere, even though all the numbers always seem to look good. These are very different. These are companies that I think, just because of the unusual situation where all the money in the market is basically getting plowed into half a dozen stocks or a couple of sectors, it's just leaving these really interesting stocks behind.
Yeah. Okay, we've got 10 minutes left. If there are any more questions, now is the time to sing out. Otherwise, we're all going to go off and get a coffee and have some lunch. So if we don't hear from you, I want to thank you first for that presentation. I'm stepping into Alan Kohler's big leather shoes for the weekend and writing weekend brief, and you've basically written it for me, I think. I just need to put some words around some choice charts. It's a very compelling presentation. I'd like to thank you for it. And just a reminder that the secondary offer closes a week tomorrow, the 22nd of August. So if you are keen on investing, we think it's a good time. We think we've got a very interesting proposition as an income fund. It's quite unusual. You can buy it on the ASX with the code INIF, INIF. And I think that's it. Anything else you need to say, Nath?
No, I just want to thank our investors who have stuck with us through this last 30 months. I know it's been painful. It's been far more painful than normal because of what the banks have been doing to our returns, and just the nature of the very one-sided market, with all the money ploughing into a certain group of stocks. But finally, we've got light at the end of the tunnel, and the good news in July, where we've basically had a year's worth of returns in 5 weeks. But to me, this is just the start of the start. So thank you to everyone. And if you're new to the fund, then you've picked a good time. And thanks for doing this with me, John.
No, it's been fun. Thanks, everybody, for your attention. Thanks for your questions. Thank you for your time. And we'll see you soon. Thank you.